Alrighty, this video will be on how to solve problem 25-3b on page 1281. It'll give you a review of the variances that we calculated yesterday in class. So if you can, get your textbook, turn to page 1281, and I recommend you get a blank sheet of paper, or you may follow along with me by downloading the file from Blackboard, and this is an Excel file under week 12. So I've actually downloaded the problem from Wiley Plus. You can't see everything, but I'll do my best to read what we have here on the screen. We have Zimmerman Clothier. They manufacture women's business suits, and they use a standard cost system. And in the month of March, they actually produce 15,700 suits. So these are the actual units. The following standard and actual cost data apply to the following standards and actual cost data applied to the month of March, when normal capacity was 20,000 direct labor hours. So the normal capacity we expect to operate at each month is 20,000 direct labor hours. Excuse me. All material purchased were used in production. So everything that they purchase, they use it to make these business suits. So what you'll need to do on your blank sheet of paper is set up a three-prong matrix. And keep in mind, we'll use the AQ times AP, and then AQ times SP for the middle prong, and then SQ times SP for the last prong on the right. And the AP are listed variables we have up here: actual price, actual quantity, standard price, standard quantity. So we're going to figure out what each one of these variables should be. Now, actual price, AQ stands for actual price. So if we're looking at direct materials, here are our actual numbers, and our actual price paid was $547,200. However, the cost for one unit of the direct materials was $7.20. So we're going to punch in $7.20. Now, if they did not tell you the actual cost per yard, what you can do is just take your grand total and divide it by the number of yards that you actually did purchase. Now, our actual quantity is given to us, so that's 76,000. Now, our standard price. So standard price is $6.75. So let's go ahead and punch that in, $6.75. And our standard quantity. Now, with the standard quantity, it says 5 yards is what they need for one business suit. But since we are making 15,700 suits in the month of March, our standard per unit needs to, you need to multiply that by the actual number of units made. So we're going to go ahead and put a formula in here. I'm just going to put in 5 times the 15,700, and that will give me my standard quantity for that many suits. And you'll notice here, when I multiply my AQ, my actual quantity, times my actual price, I get a grand total of $547,200. And then when I multiply my actual quantity times my standard price, I get $513,000. And you'll notice that the two variables that change from the two products is the AP and the SP. And if you look up here on your beginning variables, you'll see that your standard price, you were expecting to pay $6.75, but when you contacted your vendor, they actually charged you, 45 cents more a yard than what you were expecting. So you ended up paying a little bit more for the 76,000 yards of fabric that you purchased. So you'll notice here, actual quantity times the actual price is larger than what you were expecting at the standard price. So in this scenario, because the costs are more, the actual costs are more, you have an unfavorable variance. And I don't like using negative and positive because depending upon how you set up your formula, it may confuse you. Just think about what you actually paid is more than what you were expecting. So our variable is the difference between these two prongs. So $547,200 minus $513,000 gives me $34,200. So that is my variance, my material price variance. And then you look here, that's actually your check figure. So you did it correctly. And then you go on to calculate your standard quantity times standard price, which is the $6.75 multiplied by 78,500. And again, how we got that number was we took 5 times 5 yard standard for 1 unit or 1 suit and multiplied it by the actual number of suits that were made. And that gives us 529,875. And here we have a favorable quantity variance. So what happens here is that our actual quantity or actual yards that we use was 76,000, but we were expecting to use 78,500. And you'll notice as a result, because we use less, we were able to save some money, and we have a favorable quantity variance. And it might be that this is a higher quality fabric and we're able to use the grade of it and end up using less items, so there's less spoilage and waste in our making of the business suit. And then what you'll do is you can either take the net of these two variances to get your total material variance, so unfavorable 34,200 and a favorable 16,875 will give us an unfavorable variance, total variance of $17,325. Or you can take the difference between your actual quantity times AP minus your standard quantity times SP. So that basically concludes how you calculate the 3 variances for materials. And of course, as I said in class, you are welcome to use the formulas that are provided in your textbook if you do not want to use a matrix approach. So our next one is labor. And we're going to go through pretty much the same process, except this time we have actual rate, actual hours, standard rate, and standard hours. So our actual rate, again, it's given to us. They've already calculated, so we don't have to figure it out. So we're going to put in $11.20 for the actual rate. Now the actual hours incurred, we have 14,800, 14,800. And you'll see that if you multiply these two together, you'll get the 165,760, which is the same number that they've actually provided to you in the given information. And then our standard rate will be, let's see, direct labor hours, $11.45. So let's punch that in, $11.45. And then we have our standard hours. Now, again, the standard hours are at the actual units produced require how many hours? Well, it's 15,700, and the standard is 1 hour for one suit. So all you have to do is take the 1 hour times the 15,700 units that we actually made during the month of March. And then that would be standard hours. We would be expecting to use 15,700 direct labor hours at our standard. So again, we'll take our actual hours times our actual rate. We get our product. And then we take our actual hour times our standard rate. We get a different product. We take the difference between the two. And this will be our labor rate variance. So the AR and the SR are what changes between these two products. 3,700 is favorable. The reason why it's favorable, again, is we actually spent less than what we were expecting. So we spent $165,760, and we were expecting to spend, for making 15,700 suits, we were expecting to spend $169,460 in direct labor. So we saved a bit, so we are in a good standing, and that's favorable to us. Then we go on and calculate the last prong, which is standard quantity times standard rate. And again, oh, that's a little mistake. Let me fix that. Standard hours. So H and Q, depends on if you're talking about materials or, if you're talking about direct materials or direct labor. So standard hours, standard quantity, same difference. Times the standard rate, we get 179,765. And again, that standard hours is based on the fact that we actually made 15,700 suits during that month. And we take the difference between the two, we get the 10,305, and this is also favorable because we ended up using less hours than what we were expecting. And you take the number of hours, multiply it by your standard rate, and that will calculate your labor rate variance. I have efficiency variance here, but it's the same. How efficient are we when we make our suits? And make it go smaller. So we can go ahead and put in there efficiency variance, or you can go ahead and put in there our variance. So this is dealing with price, first prong. Second one dealing with quantity, also known as hours. And then if you take the net of these two, because they're both favorable, you just add them up and you will get the 14,005. And that 14,005, you can also take the difference between your AH times AR product and subtract it from the SH times SR. And you'll get the 14,005. And then the last one, B, because I'm not going to do C, but B, compute the total overhead variance. With the total overhead variance, we're not really going to calculate our individual controllable and non-controllable. We're just going to calculate the total. Get the total. All you got to do is take your total actual overhead costs and get your, let's see, can you see all that? Get your total applied overhead. So you take the difference between the two, and that will give us the total variance we're looking for. So going back to our actual, we have fixed costs of 120, variable overhead of 49. So 120 is our actual variable overhead cost, and oh no, that's our fixed. So 120 is our fixed, and then 49 is our variable per the problem. So that's a grand total of 169 for our actual overhead. And then our predetermined overhead rate is $9.40 per hour. So we're going to use our predetermined overhead rate of $9.40. And that 940 cents is going to be multiplied by the standard hours allowed. So again, that 15,700. And we have our 1 hour standard, so multiply that by 1. So we're allowing 15,700 hours. So we're going to use the standard hours allowed, multiply that by 940, and then we should get the 147,580, which is just simply multiplying the $9.40 by the 15,700, and we'll use that to take the difference between the two, and we should get a unfavorable total overhead variance. And we are done with item A and B. So if you have any questions, post in Google Hangout, and hopefully you understand the material.